This is end of chapter problem 3.2 from the CFA Institute textbook, Corporate Finance, A Practical Approach. And it's another multiple guess question. Which of the following statements is correct? All right. A, the appropriate tax rate to use in the adjustment of before-tax cost of debt to determine the after-tax cost of debt is the average tax rate because interest is deductible against the company's entire taxable income. Well, most of that's true, but we don't use the average tax rate. We actually use the marginal tax rate because look at what the cost of the next dollar is. So it's not A, but A is close. B, for a given company, the after-tax cost of debt is generally less than both the cost of preferred equity and the cost of common equity. And that's actually true because, well, there's a couple of reasons for that. And I'll go those in a second. And then number three, or answer C, was for a given company, the investment opportunity schedule is upward sloping because as a company invests more in capital projects, the return from investing increases. Well, the investment opportunity schedule doesn't work like that. So the return from investing actually decreases. You take the best projects first, and so when you're taking the best projects, your opportunity for returns gets smaller and smaller and smaller until it crosses over from your cost of capital. All right, but let's go back to B and why the after-tax cost of debt is generally lower. There's a couple of reasons, Reason number one is that there is a tax deduction for interest, but not for dividends. So Uncle Sam is subsidizing debt payments by allowing corporations to subtract interest payments from their taxable income. So that's going to, all in and of itself, going to lower the cost of debt capital. However, the big one is, the main reason, or the big reason, is that investors require less rate of return. And the big reason for that is that debt has guarantees built into it. You are promised a return on specific dates, and you have legal recourse if those payments aren't made. And when a company goes into bankruptcy, the debt holders are at the front of the line. They get paid before the preferred shareholders, and the preferred get paid before the common. All right, so if you're bankrupt, though, you probably don't have enough money to pay your debts, let alone pay that money to preferred shareholders, or, last of all, to the common shareholders. So typically, the debt holders get made partially whole, and most of the times when companies go broke, they don't go all the way broke. There's some money to pay off the debt holders. So they might get 90, 95, 99 cents on the dollar and be made mostly whole. But the preferred and especially the common are likely to get wiped out in the case of financial difficulty.